Alrighty, folks, we are doing a live Q&A. This is something we used to do with Millennial Mike a lot, but he is a SWAT officer who got a promotion, which unfortunately included the midnight or graveyard shift. So we don't do that as often. But Matt from Mojo Mindset has volunteered to come back weekly and said, hey, let's start this thing up again. And oh, by the way, we're doing this live. So this should always be interesting. Matt, the floor is yours.
Yeah, awesome. Well, thank you again so much for bringing me on, asking you, putting you in the hot seat, if you will.
Love it.
And obviously, with going live, people that want to comment, ask questions, we can kind of feed off that as well. So to kick things off, I think we can talk about, you've been an investor in real estate for quite some time. Let's talk about, do you pay down any extra principal on your primary residence? Or do you pay down extra principal on your investment portfolio? And maybe why or why not? And what are some things to consider as new investors kind of getting into that space?
Yeah, so obviously this is not financial advice. It's just the story that Olivia and I ran with. So I have a couple of thoughts here. I believe it is far more beneficial to have a free and clear primary home than it is to have a free and clear investment home. As somebody who has personal baggage from a childhood where my home was almost taken away from us via foreclosure, I'm never going to get away from that. So as a father and a husband, it was always my goal to make sure that I never was in that situation. So I believe with every fiber of my body that I'd rather have a free and clear house than an investment house. Kind of point one to that. Back when I was making those decisions, interest rates on our primary homes were 6.5% to 8%, which would mean we would kick in additional principal if we wanted to. I will kind of coach this. I don't have this decision today because we're just at a different point. But at today's, there's probably a lot of people watching this that their primary home is sub 3%. And from where I sit, again, not financial advice, that's basically free money, right? You could take extra principal, put it in a bank account today and pretty easily earn 4%, if not more. So if I was coming up and I had a 2.8, 2.9, 3.1, 30-year mortgage, no chance in hell I'm in a rush to pay that off. It is free money in my opinion. So that's kind of my thoughts on all of that.
Great. Yeah. No, I think that makes sense. Kind of factoring in the current economic environment that you're in, what stage of life you are in your investment portfolio, right? Are you early on in the accumulation phase, or maybe you're later on in some of that maybe distribution phase comes to mind. So thank you for sharing that with the audience. Looks like All Nighter Hider here has got a question. Kind of pivoting here in terms of, I guess domestic and foreign investment here. Do you see any foreign investment in the U.S. going up significantly from the sale of treasuries? What are your thoughts there, Zuber?
Well, when you kind of zoom out and see what is possible over the next couple of years, 2 to 4 years, I think it is reasonable to assume that the stronger dollar, which again, the dollar is unquestionably stronger today than it was years ago, and likely to continue against other currencies, that, foreign investment, manufacturing plants, other things is certainly possible. And I would actually argue probable. The other thing you have to think about is what are the rich people in every not U.S. country thinking? And I think there's a lot of foreign money that sees their currency devaluing and thus like to move their wealth into a safer area. I heard Ken McElroy interview somebody over the weekend. I wish I remembered his name, but I don't. But Ken McElroy's channel talking about the milkshake theory. And basically the theory goes, hey, if you're in Brazil, I think was the analogy, and you got $1 million in Brazil and you want to put it into the US system, you could put it in a money market account and again, roughly earn 5%. But if the Brazilian real, I think is their currency, falls 5%, it's actually a 10% swing. So again, it could all change in a heartbeat, but I think there's going to be a lot of foreign capital flooding, the U.S. markets. It's already started, and I think it only goes up from here.
Awesome. Yeah, I think looks like he had an interview. Ken McElroy and Brett Johnson talk about that.
Brett Johnson, that was the name. Yeah.
Milkshake.
Yeah.
Awesome. Well, thank you, All Night Hire, for that. Let's see. Piggybacking off kind of our initial question, talk about paying down extra principal on your primary mortgage. When it comes to your investment portfolio, what are some things investors, in general, should be considering when it comes to, stripping some of that equity? And we're kind of targeting maybe this could impact some of those that bought investment property kind of just around post-COVID, right? 2021, we've seen, significant, median home price increases. And maybe some people are looking around thinking like, man, I didn't know this real estate game was I'm gonna have equity this quick, right? So, maybe we can talk to those investors that are thinking, what are some things to consider?
Yeah, and again, not financial advice, just telling you what Olivia and I are doing, and it's really funny. I actually never thought this would be possible, but it's looking more and more probable. We're going to repeat what we wrote in our first book, One Rental at a Time. And I don't remember what page it's on, but pretty early in the book, I actually list out how Olivia and I did a 1031 exchange where we sold houses which we deemed as expensive and 1031 into small multifamily, 5 to 20 unit buildings. We went from 8 to 80 units. And again, the book, if you haven't read it, has the full story. I see that exact same thing coming. And, I don't know if it's 2025. It might be 2026. But I think there's a better than 50-50 chance that we take single family homes, which again, we're going to deem as expensive, clean them up, sell them to first time home buyers, take all of that equity and buy distressed multifamily. The multifamily market that we play in, Class B and Class C, it's still frozen. It's still stuck with extend and pretend, but that can't last forever. And the higher rates stay, the longer that they stay there, the more pain that the commercial banking system is going to feel. And eventually this stuff will have to dump. And it's just crazy that the longer they hold on, that the bigger the dump's going to be. So I personally, again, am evaluating all my 1 through 4 units. I would love to sell every single family home through fourplex and take all of that equity and move it into multifamily. If we went from 8 to 80 last time, we could go from, I don't know what the number is, 20 to 200, 30 to 300. I don't know what the number will be, but it will be fantastic if we get the opportunity to repeat that, because that's really where our wealth jumped, is where we made that pivot, where we said, oh my God, singles are crazy. Let's go over here to this distressed asset that's on sale. And man, if we could do that again, Matt, I would be loving life.
Yeah, no, that sounds, I said, if it's not broke, right, don't fix it. You guys talked about your story going from that 1031 exchange. And, in general, maybe for those people that they hear the term 1031 exchange, right? It's a way to, play the tax game for real estate investors, to go from, a like kind property, and you kind of get that stepped up basis. Can you kind of share maybe your, that mental transition that you said, like, wow, like what was it exactly that was it just the way that the market was from your single families, that you kind of timed it right? Or what are some things that other investors should be considering if 1031 is kind of on the table for what they want to do moving forward? Yeah.
So let's go through the full story since we have some time. I I already deemed Olivia and I to be a success when we had 8 homes. Because if you know our story, all I ever wanted was 4. And, we got to 8 probably year 3, maybe year 3.5, something like that. And, I was fat, dumb, and happy. But, one of the things you do as somebody who lost 80% of their wealth in the dot-com crash is you're always nervous you're going to lose it again. And I found a real estate event, an in-person real estate event. I think it was $100 to go listen to a guy named Bruce Norris, who I had never heard of him before. But the title of the event was California Crash. So, as somebody who has baggage from losing 200 grand to 40 grand or whatever it was, I'm like, I'm going to this event because, we have 7-figure net worth at that point, probably all in real estate, all in California. And I'm like, dude, if this guy's going to call a California crash, I got to go figure out, is he full of shit or not? And I went to the event. I was one of, 100 people there, maybe 150. And Bruce Norris goes on a PowerPoint data-driven event like I've never seen before. And this is coming from a guy who lived in PowerPoint, loves numbers. But it was like, I forget, it must have been like 300 slides or just something astronomical like that. I remember leaving the event and I only had one thought. And Bruce kept saying this word, affordability index, affordability index, affordability index. And I'm like, A, I don't know what that is. And B, I don't know what it is in Fresno. So my whole takeaway from this event was go learn what the affordability index was and then go learn what it is in Fresno. So I did that. And what I quickly understood over probably a 10-day period is that Fresno's affordability level was lower than it had ever been. And then when you stretch back the lens of history, every time it got this low or near this low, a crash happened. Fresno's a very up and down market. So I didn't need to know anything else. I'm like, oh crap, the world's going to explode. I don't want to lose everything again. I don't want to be that guy. And I sold Norris Drive and 1031. And then I sold the next one in 1031 and the next one and the next one and the next one. And the last one we sold was the month Fresno peaked. And, thankfully it closed and bingo bango, we didn't own any homes. So when Fresno crashed 75%,
Wow,
75%.
Wow.
We didn't feel it. We were safe. So yeah, I have always and will always thank Bruce Norris for that kick in the ass to realize I didn't know what was going on. And he saved us, dude. I'd still be working. I retired in 18. Olivia retired in 15. I would still be working if I had those 8 homes. And thankfully, I don't have to work because we 1031 exchanged.
Dang, wow, incredible. See, it's, goes to show, right? If you're always learning, you're always, surrounding yourself with people that know a lot better than you. It's worth paying attention. And so, with that affordability index that kind of stuck with you, are you seeing any parallels in today's market in kind of how you're pivoting and maybe shifting that strategy to then 1031 again? Or is it other factors that maybe you are considering?
No, I absolutely. Affordability index is something I look at. It is certainly less affordable than it was 4 or 5 years ago, but it is frankly nowhere close to where it was in 2006 and 7. So it's bad. It's just not horrific. There was a concern I had in the last year's election that if, Kamala would have won, there may have been some first-time homebuyer tax credits, $7,500, $20,000. I heard all kinds of numbers. And I was fairly certain that if we were going to rain down free money on first-time homebuyers, that affordable housing in Fresno would become worse than '06. And if that had happened, I would have sold everything. I wouldn't even have 1031. I would have rushed to sell everything I had because I know what happens. I've been in this movie before. The nuttiness may have gone on for a year, 2 or 3 years, but with as much real estate as we own, it would have taken me a while to unravel. So if we would have announced a first-time homebuyer program of 10 or 20,000, I would have very quickly, kicked my tenants out, done a full, rehab, and sold to first-time home buyers. I mean, because that could have taken home prices up 20%. And at that point, Matt, they would have been worse than '06, and I would have sold everything and maybe just set on cash. Would have been one of the possible outcomes.
Sure. And to that point, right? In theory, right, it might sound good for the first-time home buyer, but did you want to kind of emphasize, right? It only addresses the demand and not the supply.
That's the problem with it. Yeah, that's the problem with any kind of incentive of free money. It's all demand. And I am of the belief, and I was lucky enough to be at Lance Lambert's Resi Day in New York, and I was asked if I had a magic wand, what I would do, and it's all about supply. I would create some deregulation, tax incentives, whatever I could to go back and build smaller homes. Right now, it's just simply not profitable. And that's a problem, right? If you go back and look at the average size home in the 1970s, I believe it was around 1,000 square feet, might be 1,100. Today, the average new build's like 2,400. And, I don't blame builders. That's just where it takes to be profitable. But if I want to fix housing, we need a national emergency to build, entry-level housing. It just hasn't been important, hasn't been a focus for decades. And I think supply is the problem. We don't need more demand.
Fair enough. Awesome. Well, the Riley AOK, speaking of supply and demand, let's talk, we'll talk kind of shifting asset classes in terms of meme coins, right? So what are your thoughts on Trump doing a meme coin, kind of the weekend leading up to his inauguration? Curious with, your econ background, what effect this has, if any, in your opinion. Definitely not financial advice.
Yeah, I'm not talking Trump, Melania, any of these. I will talk all meme coins because I think for the most part they're all the same. I think even think about the Hawk Tuohy one or whatever that was, right? They're all the same. They're essentially somebody trading off a name. The masses come in, it goes up, which brings more people off the sidelines. It goes up. And at some point it doesn't go up anymore and it goes the other way and people lose, lots of money. I, in fact, think, I think when people generally talk crypto, it's a big bag of grift and fraud. I mean, look at all the people, that went to jail over this, and, Celsius guy, and, what is it, FTC or whatever the other one was?
Yeah,
whatever that.
Yeah, FTX and Sam Bankman-Fried, yeah,
all SBF, all those guys. That said, if you turn it over, I think there's legit technology, right? Blockchain, legit. Blockchain as a theory or a technology has a way to change real estate investing forever, right? This whole title process we go through in physical real estate is painful and fraught with errors, right? Blockchain, theoretically could be something that would ease that transition. And so I think it's real and legit. I think these meme coins are very much like those NFTs, right? I don't know if you guys know this, but I think Justin Bieber paid like $3 million for a Bored Ape that's now worth like 17 cents or something. Fools and their money are soon parted. I see no reason for that to change. It's not an area I play with. It's not an area I think about at all. I want to buy physical assets where inflation is my friend, ideally that produce cash flow day one. But you know what? There'll be millionaires created in meme coins, and there'll be millionaires created decades now from fraud. And it's I actually think it's quite comical, frankly. I think it's laughable how people get sucked into these things only to feel good for a moment and then get sucker punched later. So it is what it is.
Yeah. No, that's fair. It kind of just appeals to our emotions and get that little dopamine rush, and there it goes. And it's like a fleeting moment. Not certainly not a blueprint for wealth building in within your community. Awesome. Looks like we got another question from Rao Investments. So they have a question here. It says, "Thanks for the session, Mr. Zuber. What are your thoughts on build to rent?"
So build to rent is very interesting. I think it is something the large builders could do at scale and have. However, as a guy who's focused on mom and pop investors, we have a couple of people in our community that are proving that build for rent can work at a small scale. And I've talked to them, and I'll continue to talk to them. Essentially, you find a way to go find a city lot, infill lot, and you have to buy that lot cash. Then you use that lot as collateral to get a construction loan. And then assuming you could do it profitably, you could do a refi, rate and term refi at the end, and bingo bango, you've got no money in the deal and a cash flow asset. I think if you take that one step further, and you should, I think there's a lot of markets like Seattle, like San Diego, that are very expensive, where you should be thinking about doing ADUs. Graham Stephan, the famous Graham Stephan, just talked about how he is going to do ADUs in his backyard in Southern California. I think you could do the same thing. I think you like I don't know the numbers in LA, but I know them in San Diego because I have a friend that's doing it. Right now, because they've done enough ADUs, if you add a 750 to 1,000 square foot ADU, legit, permitted, legal, all of those things, you can get somewhere between $700 and $800 in value at the appraisal, at the refi. And again, this gentleman happens to be a contractor, so he has, a leg up on the competition, but he can build them for about $400 to $450 a square foot. So if you're in that kind of math or that kind of ratio, creating an ADU is literally like printing money. So I'm a huge fan in build to rent if you can make the economics work. And I think more and more people in my community are proving it works. And that makes me smile. So I think it's cool.
Awesome. Yeah, fantastic. I think you said kind of hit it on the head, right? It's that local rules and regulations, what, to address kind of going back to that affordability index, right? If you're in a market where, that starter home is not really affordable for the first time home buyer, right? What options and are you kind of exploring? I think, like you said, that ADU really provides an outlet for people to build more price per square foot within the, a single lot. So awesome. All right. We kind of have again, not financial advice, but maybe a hypothetical, right? So let's say Zuber, right? He's 18 years old, joining the military, right? So what would you do? Your options here, we got stay in the military for 10 years to earn a taxable pension, potentially worth, looks like it says $2.5 million, retiring at 39, living until about 35 or 85, excuse me. Or the other path, which is you kind of leave now, triple your income, settle in one place, continue investing in an area that works. I think there's certainly a lot of variables maybe in this question here, but what would be, I think we can kind of simplify this in terms of like, if you're working a 9-to-5 job, right? You're staying in that 9-to-5 job. I'm imagining that tripling your income, we could talk about whether you're learning sales, you're maybe in real estate. I'm sure you have probably some other avenues. What are some questions you're considering as you go through this thought process?
So again, when I look at questions like this, what it tells me is, or what I'm reading between the lines is the initial plan was to join the military for 20, do your 20 and get a pension, 18 to 39. You're now halfway through, right? So you've done half the mountain. It's down the other side. But, you're looking at potentially exiting and entering the general workforce, which here says it will triple your income. I guess I have a couple of thoughts. The first thought is, and Dion, this didn't happen for him, but he was actually downsized in the military. But what I'm going to say here is it's probably unlikely the military is going to downsize over the next short term. And the reason I bring that up is I think there's still some churn and pain coming to the traditional market. And, maybe you'll triple your money now, but maybe you'll be laid off in a year or two. And that's not fun. You're also you're already up to the mountaintop. You're now coming down. What's to say you can't do a side hustle, right? And still complete your 20, get your 2.5 million or whatever it was. You're still going to have 40 years left. So again, I don't know this person, their situation, but there's, in my opinion, looking at this, there's nothing wrong with finishing your 20 and starting something on the side and building that thing for a decade. And oh, by the way, let's not forget the best real estate or the best investing story I heard in 2024, Sarah Garrett, hopefully I'm pronouncing that correctly. She was in the military and she bought a new home, a new rental every time her duty station changed. You want to talk about a cheat code to wealth? Do that, right? I mean, Sarah's story is amazing. If every enlisted person or unenlisted, or whatever the right term is, just bought a home that cash flowed every time their duty station changed, you retire in 20 and you have 7, 8, 9 rentals, dude, cheat code to wealth. So don't shortchange the military by thinking there's a, tripling your income. There's a lot of downside in the other stuff. So I don't know. There's my random thoughts.
Love it. Yeah, no, I think that's something to be said, right? For maintaining that career and, like you said, building that side hustle for 10 years. And in the military, right, you have that VA loan tool, which we've talked about, kind of our story. And I think, like you said, don't shortchange yourself. You can use those tools to separate yourself and build yourself something new outside when you get out. So that way it's a little bit easier to transition, not just kind of starting from zero. Mm-hmm. All right. All Nighter Hider got some more 1031 follow-up questions here. So it says, do you think the 1031 is more secure as far as continuing to remain an option now that Trump is in office?
I don't think the 1031 exchange would have been impacted by either party. The one thing that may have happened is the 1031 may have been stripped away for the big boys, right, who use this 1031 exchange as a way to delay taxes until they die. I never would see it going away for mom and pop investors for single family homes. Why? Because too many people in Congress use it. I mean, let's just be real. If we've learned anything about Congress, they're not going to do anything that hurts themselves. So if the 1031 exchange was to see any kind of tweaks or changes, it would be for, billion-dollar players, not for one rental at a time fans. So no, I'm not concerned about it going away frankly, with either party.
Awesome. Yeah, and makes sense, right? It talks about certain threshold of building wealth and kind of what's your what is it called? Your aggregate taxable income, right? It's like we're talking small potatoes compared to the bigger fish, so to speak, in the market. So, all right, okay. Looks like Angel here has a question. Is bigger typically better, and what is your best performing property?
Bigger is not always better. And again, I only evaluate properties at the point of acquisition. When we started, it was singles, then it went to multifamily, then back to residential. Today, it's tough on both because it's really about when you buy. And I am not somebody that thinks bigger is better. You know, you hear these people talk about, oh, I only got one roof, and if you lose a tenant, you're only this and only that. Um, I've seen plenty of people lose money with single family homes, and seen plenty of people lose money with multifamily. I think you got to know what a great deal is. And again, let's be very clear. I teach this concept of learn average and then only do great deals. I put every single asset in the same spreadsheet. I don't differentiate. And I'll use real examples. I own a 512 square foot, 1 bedroom, 1 bath house. At one point, that was the best yield I could find. The other thing on the opposite side, the biggest we own, which is small potatoes, I understand, but it's the only story I have, is a 20-unit building. At one time, the 20-unit building was the best yield. So I put everything in the same spreadsheet, and I just let the spreadsheet tell me what's the best yield. And I buy what's the best yield. It has been and always will be that simple.
Beautiful. Yeah, I think it takes a lot of that emotional maybe decision making away and strips it from that process. Yeah, bigger might just be bigger headaches, right? Like
Oh,
for us, bigger is insurance is 3 times higher for a triplex than it is a single family, right? So it's
turnover. So the big thing
uh,
is turnover. People don't understand.
yeah,
I think it's still true. I haven't done the math in a year or so, but my average tenure in a house is over 8 years. My average in an apartment is under 3. And for most landlords, and if you don't know, I'm about to tell you a secret, the losses come in turnover. So yeah, there's that story.
exactly. Yeah, if you're not setting aside those cash reserves, vacancy will eat you up. The turnover, how long it remains vacant, the cost it will do to turn over that property, the cleaning, the carpet cleaning,
Yeah,
the paint, the
you're
drywall,
giving me
everything scuffed
PTSD,
up.
Matt.
I
Stop
I
it.
know,
Stop it.
I know. But there's the truth. That's a little nugget for everybody thinking that real estate is all sunshine and rainbows. There are those hard days.
Yeah.
Awesome. Yeah, we're just over kind of a half hour here. I think we got a good mix of people's comments, our questions. Any direction you'd like to go? I know we talked 1031. We talked about paying off a primary, paying off investment property. Any other
No, this
final
is
last
fun.
words on that?
No, I think this is a lot of fun. I appreciate the opportunity. I think doing these lives are a lot of fun. So anytime you have a day or an hour that works, let me know, and we'll just keep doing them live. I think these are a lot of fun. If you haven't bought tickets to Vegas, go get it on Eventbrite. I think we have 47 tickets left for VIP. Best of all, though, join School. I think School is the place you need to be. It's 67 cents a day, and if you want to be around people really doing it, this is the spot. So that's the thing. What did Frank have to say?
Fantastic. Yeah, Frank, old guy REI, generous $5. Seems like you're doing quite
Woohoo!
well today. Why would you trade fixed debt for commercial debt now? Okay, so kind
Exactly.
of hitting that topic we brushed on earlier.
Yeah.
What are your parting
So
words?
yeah. So a couple of things. Residential debt, obviously 30-year fixed. Commercial debt, historically 5, 7, or 10 years. However, I have a relationship with Velocity Mortgage, Stephen Dow, who allows me to structure 30-year fixed rate debt on apartments. And he helped Olivia and I get sub 4% debt on apartments. And, it's not 4% today. I'm not trying to say it is, but you do not have to accept 5-year, 25-year AM debt on commercial if you don't want to. There are players like Velocity Mortgage that offer 30-year money on apartments. So I will most likely 1031 with such monster equity that I will once again get 30-year debt on apartments. I don't like short-term debt. One of the scariest days of my life was calling a seller finance deal, asking for an extension because it came up at the wrong time. So yeah, so I like 30-year debt and will likely get 30-year debt again on apartment buildings, thanks to Velocity or like provider.
Awesome. Yeah, wow, it really kind of blends maybe the best of both worlds, right? The residential debt on a commercial asset. I think that's fantastic. And kind of speaking of commercial properties, how long a hold on maybe 5 to 10 units my initial thing is how's it performing, right? What
Yeah.
what state of the market are we in? But what are your thoughts on that?
Yeah. So my general thought on anything I buy, whether it's a 512 square foot single family or a 20 unit, is I'm going to own it forever. And typically, what will happen by year 3, 4, or 5 of ownership is we will look at it, and if it's grossly underperforming or the area has changed and it's now become a problem, we'll sell it. But generally speaking, until I'm at the third stage of life, which may be a decade or so away, it's just buy to keep.
Yeah, keeps it simple. Awesome. Let's see. Looking here, Zuber. Well, definitely. Thanks for giving us the opportunity to kind of ask you some live Q&A. You talked about your Vegas event, school. Is there anything else coming up that you need to tell people about today?
No, except go check out Mojo Mindset. You guys are doing amazing things. I need to follow what you guys are doing.
Awesome. Well, yeah, we're just trying to, like you said, just do our own tribe, document our journey, and stay in the W-2, right?
There you go. Thanks, Matt. Take care of yourself. Enjoy. Next time.
Awesome. You too. Take care. Bye-bye.